Hello and welcome to Gemcast. Is your sense that this is the end of the road?
I think this is the end of the beginning. This is where the first phase of private credit ends and the next phase starts. The software industry, the AI impact, that showed that the correlation matters and the concentration matters. So you have some liquidity mismatch. When capital is inflowing, no problem. When capital is outflowing, problem.
Why is EM well positioned to kind of be more robust?
You have real assets, infrastructure, utilities, natural resources, driven by proper tailwind and economic growth.
What does it look like? What does the future of private credit asset allocation look like then?
I need to hold myself back.
Hello and welcome to Gemcast. Today I'm joined again by Felipe Berliner. Hello, Felipe.
Hello, Tom. It's great to be back here.
Good. Second time. So you obviously had an impact the first time.
Thanks for the invitation.
Absolute pleasure. So look, last time you were on here, and that's the reason you're back, is that there were some pretty prescient predictions about what would happen in private credit. So we're going to call you the sage of New Burlington Place today.
Oh, yeah. I started everything, didn't I?
You. So look, what's happened since we met? So we sat down in June. We were talking about the evolution of private credit. And at that point, we started sort of touching on lots of the things that we thought about developed market private credit in terms of the market reaching a bit of an inflection point. There was too much capital, yield compression, leverage was becoming layered. And there was a sort of this sort of challenges around that asset class that you felt were coming. As we've then moved through the year, kind of then in October, you revisited it again. You wrote a paper on it. You touched on some of those points again, sort of shared some data and some charts to sort of kind of elucidate that point. We've then had Tricolor, First Brands, and now we have the kind of challenges around some of the liquidity in these BDCs. So that sort of sets the stage for where we're at. You've obviously seen some of this coming. So I think it's going to be really useful for everyone to see what comes next, maybe from your sage-like position. So look, do you think this kind of collapse of private credit in the developed world, what does it mean? What are your reflections? Kick us off.
First of all, I don't think it's the use of the term collapse of private credit is correct.
Yeah.
Okay. I think it's specific to a sector. It's specific to mid-market US, specific to LBO-backed financings. So this does not define an entire industry. Okay. So yes, you drew the timeline very precisely. We first talked about it in June. And at that point, we were seeing the convergence of the asset class, private credit, with the more traditional public market strategies such as high yield or broadly syndicated loans. We saw covenants getting lighter and lighter, the underwriting standards going down. Okay. In October, we wrote the opinion paper, the Beyond the Comfort Zone, where we made the point a little bit more emphatically about the correlation issues that we were observing, and the fact that too much capital in the system were driving the credit spreads to be tighter and tighter, and that could not be healthy. And we could see that movement of the institutional investors trying to think of what is the next step out of it. But then what was surprising was the speed that this whole process developed, okay? Yeah. So it started with, as you said, Tricolor, First Brands, and it brought a little bit of what's going on. And then Jamie Dimon with the cockroaches comment that basically, well, if there is one, there's more. And finally, what really triggered and brought the spotlight on the industry was the Blue Owl publicly traded BDC versus the private BDC. And it really demonstrated that there was a gap in valuation between what was publicly traded and therefore more price discovery versus what was being marked to, or not being marked to market on a private instrument. So what happened here is that I believe that the movement of retail investors into the industry was maybe a bit too fast, too soon, and with the managers not taking enough care about the liquidity terms, right? If you think about the average duration of the portfolios of the BDCs in the US, that's around 4 years, while if you get this 5% per quarter, and you max it out every quarter at 5%, that
Yeah.
will give you a 2.5-year duration. So you have some liquidity mismatch between these two, that when capital is inflowing, no problem. When capital is outflowing, problem,
Yeah.
right? And we are talking about retail, which is an investor group that is very correlated between themselves. It tends to move together, right? So the software industry, the AI impact, that showed that the correlation matters and the concentration matters. Even though you can have 300 loans of $5 million each, when a whole industry is under scrutiny, they all will suffer, irrespective of the underlying conditions of each of them. Why is that? Because if an investor wants to get out of this fund, what the BDC would have to do, either it has liquidity, which they may have burnt already on the previous rounds of redemption, or if not, they will have to sell. But when you sell a portfolio of loans that are correlated and small tickets that are not controlling stake, you tend to mark down the entire asset class or that entire industry inside your books. That brings the value down. More retail investors get scared by that, and accelerates the process, as we've seen in so many industries before.
So it's sort of, I would say, the perfect storm, but probably wasn't the perfect storm. It was a mixture of factors that could have quite likely happened, really, in the sense that there's nervousness and jitters around a specific section of the market, products that are not necessarily perfect match to the liquidity profile of the underlying, flighty investor group that's liable to change its mind, and that kind of creates the cocktail of where we've been. So is your sense that this is kind of the end of the road, or is it a bit of a wake-up call for everybody to say, okay, there was some obvious stuff that could have been done differently here, and how does that kind of work? What's the future of the
No, it's definitely not the end of the road for private credit. Absolutely not. I think this is the end of the beginning.
Okay.
This is where the first phase of private credit ends and the next phase starts, right, as we were talking about it before. And what is this first phase? This first phase was the growth, is the adoption of the asset class. And it's still the case. All the reasons why private credit is an interesting asset class, they are still there. Right? You still have a need for flexible capital. You still need borrowers that would pay for this flexibility, right? What happened is this shock that is happening now will basically reset the industry to the standards where it should have been. Okay. So all this lightening of covenants, the loose underwriting standards, the excess capital being raised, well, that's slowing down. So if you have less capital, you go back to having an industry where the power flows back a little bit to the lender side, right? And with that, you would probably going to see the next vintages of private credit to be more responsible on the underwriting standards, to be demanding stronger collateral, so that what we are seeing now doesn't repeat in the future.
Okay. And so therefore, then I guess thinking about the evergreen structure as well, your view on that is actually just managed in the right way. That's a really effective structure for investors to access the asset class. It's just the case that the portfolio construction that goes into it needs to be thoughtful of the underlying liquidity requirement.
100%. I don't think evergreen structure is the problem that we're seeing here. Yes, for the retail investors, yes, for the specific mid-market LBO US, this is an issue. But let's differentiate what evergreen means, right? Even inside the US mid-market, you have the BDCs that do not have any obligation with respect to those target commitments of drawdowns. And you have interval funds under the 1940 Act, where the fund manager has an obligation to buy back a certain percentage that is pre-agreed. So I think it's what needs to be observed is that the asset manager needs to commit upfront to what it can do and manages liquidity accordingly. Okay, if you don't do that, you're going to create a problem for your retail investors. So if you have a 1940 Act and the investor says, okay, I want to redeem my capital, and everyone's leaving at the same time, but it's 5% because it's already contracted, well, that's predictable. That's the product that was purchased in the first place. But if the investor wants to get out based on the target redemption drivers and the fund is gated below that, well, that's not good, is it? Because then the expectation that the investor had, it's not materializing. So even inside the evergreen space, on that industry, you have to differentiate on what is a commitment versus what is an indication.
Yeah.
Okay? Now, let us differentiate as well the evergreen structures that we see in the developed market, US mainly, and Europe, versus what we see in emerging markets. Most of the loans that are inside these BDCs, they tend to be small loans, part of larger syndicated loans.
Yeah.
They tend to have bullet payments, so subject to refinancing risk at the end, and the increase in the PIK components.
Yep.
Okay, what by 2020 was around 5%, the PIK components. Today, on average, I think you're north of 8%, with some of these BDCs getting to 17% or more. This is way too much, right? So when you have a product that requires liquidity windows to pay for the redemptions, and you know that the investors will require that liquidity more or less at the same time, you need to think, is this the appropriate structures for the specific underlying loans that are inside? I think you need to match the liquidity of the underlying, the maturity of the underlying loans with the amortization schedule and the liquidity windows of the fund that you're offering. Now let's translate that into emerging markets. How do we manage our transactions? Because of the structure of emerging markets, you don't have much bullet repayments. Lenders do not like to be exposed to refinancing risk at the end of the life of a transaction. So the way we do all our deals, they have amortizing structures, meaning you will see the cash flows coming back to the fund throughout the life of that loan. If something is going wrong, you'll know that very early on, because the borrower will start missing on payments of amortization. That brings you the first red flags around it. Secondly, all our deals are cash pay. We don't use PIK components, maybe in minimal amounts and in some specific cases. PIK component is not a problem. It's when the PIK component is masquerading a bigger problem. Yeah. Right? When it's basically a selective default hidden inside a PIK. Yeah. That's when where the problem lies. So the way we manage our products, which is cash payments, amortizing structures, no PIK components, and a duration that matches the underlying structure of the fund and the liquidity windows, that's a very interesting product to have, right? And Evergreen has been growing for that. There is demand from institutional investors, that pension funds and pension schemes that have regular capital inflows, that they have the demand to deploy as well in accordance to the same frequency, the capital inflows, rather than waiting for a next close. So there are interesting features for the Evergreen structure that I still believe in them very much. It's just that the industry has to adjust to what it really means, right? Okay. You need to match the liquidity. Every single time in history where you have liquidity mismatches, it ends up in tears. Okay. And we need to be very cognizant of that.
So we've got a situation. So private credit, there's still a future for that. We still think there's a massive demand for that kind of capital, that flexible capital for borrowers. We also got fund structures that just need to be managed in the right way. So we're kind of going into this sort of private credit 2.0, and I know you alluded to that when we spoke in June. So where does the capital go? I read front page of the FT today, we're talking about a European private credit boom now. So
define boom.
Define boom, exactly right. So that doesn't necessarily sound like a good thing, but is that where capital is going to go now? So out of the US, that's not the trade anymore. We go to Europe. What does it look like? What does the future of private credit asset allocation look like then?
I need to hold myself back on how I'm going to answer this here, because the market is what the market is, right? But what is in the cover of the FTE? It's really what's happening, right? Just came back from a trip to Asia and seeing a lot of pension and insurance companies, and all of them starting the meeting asking for explanations of what is happening in private credit in the US and demonstrating some concerns about that. And every single one of them, when I ask, like, okay, so what are you doing about that? I say, oh, mid-market Europe. I say, oh, all right. The article is accurate. You're seeing an exodus of capital from these mid-markets LBO, AI concentrated, not AI, sorry, software concentrated portfolios in the US into mid-market Europe. But what is Europe? Okay, people see it as an extension and an ability to continue investing in private credit as if it's completely ring-fenced to what's happening in the US. But it's, yes, it's a different market. There is potentially more red tape than you have in the US. But at the same time, Europe doesn't have the same level of growth of the US. Okay, and secondly, last year, in terms of the direct lending, 30% of direct lending that happened in Europe was for software industry, the broader technology, broader technology sector in Europe.
Yeah.
So instead of stopping and thinking, okay, how can I really benefit from private credit? How can I diversify this risk away? How can I benefit from the various options that are out there? I think the investors are just buying another point in the cycle instead of really making the hard choices, or not the hard choice, or going beyond the comfort zone that we talked about, and starting to think more broadly, where are the opportunities? Where is the diversification? Where are the uncorrelated returns with proper cash paying and real assets?
Yes.
Right? If you have an industry, an economy that is mainly driven by intangible assets such as the softwares, and this is what development economies are like, right? Is the technological dominance. You will have issues, the same that you're seeing in the US, that will be affected by when AI will cause problems to a variety of industries. Now you bring it back to the EM space, you have the opposite, right? You have real assets, logistics, infrastructure, natural resources, driven by proper tailwind and economic growth, which is a very different story, right? Asset back versus intangible. This is very important. But on the European front, I think it's correct. It's receiving a lot of inflows from institutional investors globally.
And is the composition in Europe the kind of same? So we think, is it the same kind of sponsor-backed sort of mid-market lending? Is that, in the same way that it was done in the US? Is from a structural perspective, I appreciate the point around the sectors being similar, but is the same structural trend in terms of where we are in the cycle, or are we earlier in Europe than we were in the US? Is there an argument to say, okay, well, Europe's maybe 2 years behind and there's still a trade there? Or
Some is the same managers. It's the same managers that held most of the capital under this strategy in the US. They're offering the same product for Europe. Now, is Europe a completely different market? I think so, right? It's still more fragmented, even though it's the European Union, et cetera. It's still more fragmented than the US. So you have different regulations in different spaces that would build a case for specialization of the manager. But essentially, the underlying portfolios, they look similar.
Yeah, okay.
So I think the difference here, I think the European banks still participate more than the US banks. So that creates a bit more competition for the private credit.
But it makes it worse then even.
It makes it tighter.
Okay,
yeah. So the yields that you achieve in Europe, they are not so interesting.
Okay, so so where in the world are yields interesting? I know your answer to this question, but so you talked about intangibles in EM. Obviously, we've got more interesting yields. So, and also probably just want to touch on, you wrote in February about this kind of, and you've talked about this AI threat to these software companies and why that kind of created this stumble. Why is EM well positioned to kind of not necessarily take advantage of that, but be more robust?
Yeah, I think that's the point I was trying to make. It's while the developed markets, basically these loans are based on private equity multiples, right? That imply a lot of leverage inside the system. When you look into an intangible assets, right? That's the nature of the software and tech industries, like these high multiples based on intangibles. When you look into emerging markets, that's not the case. That's not what we are seeing on the private credit industry in emerging markets. We're still seeing hard assets, real assets, infrastructure, logistics, utilities, natural resources, real companies and consumer-driven corporates that are still borrowing from us and from private credit. There's so much demand. The capital gap, and we talked about it before as well, that the local economies are not deep enough to fulfill the needs for the growth that potential of those economies, and the private credit is filling that gap. So it's not so much about multiples, it's about core. Right? And when you have core, we're talking about real assets. You don't have such an issue with the mispricing or valuation gaps or valuation perceptions that would move as in tandem, right? And this correlation that we're seeing inside the portfolios. We like to have portfolios that are more concentrated, that have idiosyncratic risk that we understand deeply, and having a good grip, control over those specific assets with hard security over those assets, and not being like a small ticket in a large syndicated loan on an intangible assets, which are leveraged. So if something goes wrong on a leverage asset, the recovery is small. Okay, by definition. So what you see in emerging markets is that the leverage is much lower with hard assets as collateral, proper security packages, that even if something goes wrong, the recovery would probably be higher. Now, I'm not advocating that emerging markets completely isolated. I always talk about correlation, and when things go wrong, all asset classes tend to increase the correlation between them. And in the risk-off scenario, emerging markets tend to be the loser, right? But we are patient capital, right? Private credit is a long-term play. It's not something that you should put your money in expecting to make truckloads of money in 6 months. That's not what private credit is about. It's about long, stable income and patient capital. And I think that's the main differentiation.
So, in light of everything you said, talking about Europe, US, all the rest of it, where do you think we are on the route in terms of institutional investors adopting EM private credit as a kind of mainstay in their portfolios? What are you seeing when you're talking to clients? What are you kind of hearing on the road? How do you feel about the kind of that process where we're getting up to?
I think if we were a year ago, pretty much in April last year, when Trump announced all the tariffs, at that point, it was very much an educational process, and the question was why diversify into EM private credit. I don't think the question is still the same. I think the question now is how. Okay, and because it became very clear that having this over-concentration in US or even in Europe, it's not the best strategy going forward because of correlation. So in order to achieve proper correlation, investors will have to go into other geographies and other kinds of products rather than just the mid-market direct lending. And there is such a big range of, wide range of products that you can do inside private credit that is not just the direct lending to corporates, especially those that are backed by PEs. You can have infrastructure. That's still one of my favorite topics. I keep talking about this. It's stable, it's resilient, it's core, it's supported by the sovereigns. You have supranationals involvement, and there's so many opportunities out there. And that even goes beyond the geography where it is located, right? Because you have all this setup, the structuring around this that makes infrastructure a very resilient play in a market that is in a slight turmoil or at least concerned about the future of the industry. I think for me, infrastructure is a very interesting segment of it. So when we're talking about the emerging markets and the how, I think we go back to the point of who's your manager, who is actually investing the money. And I don't think that just investing on MB tracker or just a long-only bond fund is the solution for everything, especially now that the credit spreads are still tight, right? You had the conflicts in the Middle East, you have the issues with credit in the US. The market did not really blow up. Okay, you had an issue with equities for some time, especially on the tech, but the market did not blow up. So the credit spreads are still tight. If you're comparing the value that you can achieve from private credit in emerging markets versus the alternatives in the public market, long-only index trackers, I think the private credit would be a clear winner. I know that you have strategies such as distressed and other special seats in the public market that can be interesting, but they do behave a bit like private credit, to be honest, because the liquidity is it's not that large. So investors they have the option. Either you can go into the traditional long-only bond fund or an index tracker just to say, okay, this is my exposure to emerging markets that are now again in on the spotlight, that are popular trade, or you can take one step further ahead of the curve,
Yep.
right, and make a move into something that adds real value, not only from a yield perspective, but also from a portfolio diversification and uncorrelated returns, because the public markets, emerging markets, will still be more correlated to developed markets, public markets than private credit.
Yeah. So, Felipe, on that, I think we will say thank you very much. It's certainly been an interesting discussion. Private credit's on the front of every newspaper at the moment, along with some other events as well. Cracks are appearing, the structures are being tested, but it seems like this is the end of the beginning, which I thought was a lovely line to use. And so as we move into the next phase, it's going to be about diversification, looking further afield and looking to emerging markets. So thank you very much for joining me, Felipe.
My pleasure.
Thank you for listening. If you want to find out more about Gemcorp Capital, visit www.gemcorpcapital.com.